So I was talking to a group of entrepreneurs the other day about investing in real estate, and I was telling them like the days of easy money is gone. You're going to have to invest with somebody who's very experienced, who knows what they're doing, who understands how to navigate right now, because you have to be a better investor than an operator. Like I understand operations. I've bought deals. I've managed my own deals. I've managed deals for me and my investors. I've sat in on banker meetings. I've done the funding. I've raised capital, the debt and the equity for me and my partners. I've sold off the deals, which is disposition, like you sell. I've dealt with the brokers. I've dealt with appraisers. I've dealt with everybody. Like that's good, but you also have to be a great picker. And I was telling the people who were talking about investing, I was like, dude, like I'm a great picker. I don't like losing money. I'm very meticulous in the deals I pick. And there's something specific that I'm looking at in every deal. And simplicity is like, I don't want to lose money, and you shouldn't either. You should be thinking about capital preservation. Most of my guys or gals, they're business owners, entrepreneurs. They work their butts off. They don't have time because they're running their business and taking care of their families to make an investment and then look back and go, hey, how's my investment doing? And be worried. They want to be able to park their money and sleep at night. That has everything to do with being a good investor, meaning like you're investing your money, right? Number one thing is capital preservation. So I was talking to them about why right now is valuable in the market. And there's a couple of different reasons why I believe this market is is going to produce one of the biggest buying opportunities, investment opportunities of my investment career, real estate wise. Over the last 27 years of all the deals I've invested in, is really kind of prepared me for this market the way that we're in, because I got built in these type of markets where there was nothing moving, nothing selling. There was blood in the streets, but it was blood in the streets then from the little guy. This one is the big one, so I'm prepared for that. So number one thing, when I'm making sense of an investment, which is what I was sharing with them and I'll share with you, is number one, don't lose money. So I know this got a little dark, but bear with me. um so when I'm taking a look at a deal, let's say we're taking a look at a $80 million deal. $80 million. That's the deal, right? So, and if the $80 million as an investment for you scares you, it shouldn't, because you're not going to come up with the whole $80 million. We're going to put about 40% down. So let's just say in this deal, we're going to put, I don't know, $40 million down. We'll go half just for conversation's sake. So when I'm thinking through a deal, I'm like, all right, if we were to get a great deal right off the bat, I know this needs to be a great deal, $80 million on the purchase price, and I think we're going to put down $40 million to make the deal work. Now, I know that's 50%. We usually go 40% or 45, but bear with me. Man, the color sucked. It kind of changed. But I'm doing this because I'm rushing through this because I got to zoom. We got to jump on really quick. But I wanted to share this. This is in line with you need to be a good investor and how do you make sense of a deal. So right off the bat, I'm like, okay, if that 40%, my target return on our down payment, on our equity that we put down on a deal needs to be roughly, I'm targeting if we can make 5% on our money. So let's say on this deal we made 5%. Looking at 5%, that's about $2 million a year. And that's in cash flow. We should be able to make cash flow after we pay our debt, after we pay our expenses, and this goes out to my investors. This is what I'm looking at and me for being able to invest that money in the deal. We should be able to do this. Now, when I look at a deal, I underwrite every deal for 10 years. So let's say we're in this deal for 10 years. That's $20 million. I'll put the full zeros on there. That's $20 million. That's 50% return just in cash flow on our 40 million that we put. So we already got half of our money back, just parking our money in a great deal, managing that deal correctly, and sending out $2 million to my investors every year. That's the target, right? We can build that up. Now, I get it. It's not compounded. It's not like, oh, like we're not looking at that. I'm just showing you the way that institutions and banks do their deals. And if you don't think they do, this is what they do. Just simplicity. So we got 50% of our money back. That's great. But over 10 years, I'm looking at every deal like, hey, if we have a great deal, great location, Class A property, Class A amenities, best in class deal, great location is key for me because that makes the deal make sense or not. You can't change the location. You can fix a property, you can make it pretty, you can make it nice, but you can't change the neighborhood, the location of that property. Someone's got to want it. So let's just say I can't believe over 10 years rents won't increase on that asset if it's a great property, great asset, great location. So my thought is this. I know that, and this is my investment. That's why I like multifamily real estate. I know every 10 years rents tend to double in this country. I think the average rent in this country right now is somewhere around 1,500, 1,700 bucks. It might be 1,400. Now, that's not California, that's not Hawaii, that's not New York, and definitely most places is not in Florida anymore, Georgia. Like that's the average rent across the United States. But I know since 1945 in this country, rents have continued to go up anywhere from 8 to 9%. Some less, some more, but that's the average. So let's just say rents on a conservative basis, let's say they go up, we underwrite anywhere from 3 to 5%, but let's just use 5, right? So let's just say we're going to get an increase of another 5% over and above the 5% that we're already getting, because this is extra. We increase the income of that property by there. So that's another, let's say, $2 million. Boom. Let's say we don't get that for the full 10 years. I don't underwrite it for 10. I go conservative. Let's say I can't get it for all 10 years. We didn't increase the rent by 5% all 10 years. We only did it for 5. So that's another 5. So this right here works out to be another 10 million, right? And I'm gonna have to cut out the zeros in this thing. So that's another $10 million. So right off the bat, we have 20 million, we got $20 million back over the 10 years, and 5 of those 10, we had an increase of another $10 million. That's $30 million that we already got back on our money. Boom. That's just in cash flow. You see that? Good. Yeah. That's just in cash flow that we got. Oh man, I'm gonna pull this back. Right. So we already got a well over 50% return on our money. Actually, that's what, 75%. So that said, now we got $30 million back. Boom, boom, 30 million. That's cash flow, right? And later, this is again how I make sense of a deal. This is what I'm telling people. If you keep this simple, you'll get it. I know I keep going in and out color wise, but I mean it is what it is. Um, I'll move it over some for those who are like, oh, your color's flashing. Dude, get over it. Like this is about investing, right? So then later, like we said, we didn't lose. I want to go back to this. This is a very important point. I talked about this. Number one thing, do not lose money. So we never lost our 40 million. It's just went into the deal. So if we have a 200 unit deal, 175 unit deal, 198 unit deal, whatever, right? The $40 million, because again, we borrowed 40 million from the bank and then we put in $40 million collectively. It was 100 of us, 50 of us, 10 of us, whatever, it doesn't matter. This money went into the deal. So these apartment buildings that I look at, I treat them like a bank. You take your cash that's going down in value, your trash cash, and you convert cash, paper money into, or digit money into a real asset. That's what apartment buildings are to me. That income produce, that pay you. So you didn't lose your 40 million. We didn't lose our 40 million bucks. So we got 30 million. Now we have our 40 million. So let's say later I go back in, one exit, one exit. I go back in and I said, we know we have to sell this property, right? So we already understand if we're going to sell this property, like when I'm looking at this deal for $80 million, I got to sell this deal to double $120 million. So we're going to turn around, sell this. We're going to give our investors, all of us are going to get all of our $40 million back. Plus, we already got 30, that's 70 million. We already got 70 million back. We'll just do the 70 million. Plus, I want another 40 million on the top of that. Boom. We'll just make that there. So right off the bat, that's we sold it for here. We got $70 million plus another 40 million. That's $110 million. So our $40 million, initial $40 million turned into 110 million. That'll be divided up by our investors. So that's what is that? 275% on our money. Like that's how I look at a deal. That's 275% on our money. So when I'm making sense of a deal to invest in the deal, like I said, the investors have to be the financial engineers of this thing. Now, this is conservative. Now, the other thing that I can do, and I was telling my entrepreneurs this, the guys who were talking about investing with us. So I could always, so let's say we have that same deal. So we have our 40 million that was in. I'm gonna stop writing all these zeros. We have our 40 million that we still have, capital preservation. We have our $30 million, right? This was cash flow that we got over the 10-year hold, right? This is the cash flow. Now remember, we still have this. So what else could we do? Because I've done this repeatedly. I've done it over and over again. I go back to the lender because I know the new value that I need to hit. And then I go, hey guys, we know that the value of this property is worth whatever, 120 million bucks. I want to refinance the property and I want to take out our down payment. So then I turn around on a refinance if this works, right? If this would be a target or a goal, I would now have this $40 million that we took out. Now we still got this already. This already went to the investors. This right here, I refinance this on a refi, give this back to the investors, and then that investment is an infinite return to the investors. And oh, by the way, this $40 million on a refinance, instead of selling it, we keep it. $40 million on a refinance now goes back to our investors, and that's a non-taxable event, right? Because we refinanced it, recapitalize our investors, and then we keep the deal. And that deal continues to cash flow. Now, we're still going to go off and get the $2 million a year or whatever that works out to be the extra, $3 million, but it's going to go down some because we refinanced the property, took out some money, and now we still hold the property. So that makes our investors an infinite return, and we still got this great asset in a great location, and it's continuously going up in value because I'm not going to stop continuing to increase the value of that property by raising the rents, managing it correctly, treating our residents and our tenants good. All of these things matter, but when I'm thinking through the investment of a deal, this is what I'm thinking through. Now, I learned this process over time. I didn't know this when I was young, but later I started learning. I started getting mentored by brokers, other people who had millions of dollars worth of real estate, and they were playing this game the right way. All right. So this is what I think through when I'm thinking about a deal, which is why I was telling these entrepreneurs, I was like, look, the days of someone, the days of people being able to go and just get a deal and invest, like really take a value add deal, like a fixer upper apartment building, and they're going to paint it and do the parking lot. There's more ways to make a deal valuable. But then if you're just an investor, if you're an investor like me, I'm a conservative guy. I'm not a get rich quick guy. I believe in create wealth for sure long term. I don't believe in get rich quick. I've never been interested in that. I want sure things. And this to me is a more sure thing. Those guys that like to go and grab a property that's beat up in a bad neighborhood and fix it up and hopefully raise the rents, put a bunch of like lower income Section 8 properties there. Nothing wrong with that. It's just not my strategy. And I believe, like I said, if my number one rule is don't lose money, then how could I lose money? Wrong asset, wrong location, not being able to execute my plan, getting timed out of the market. That's what happened to all these people just recently. The interest rates went up. They bought these lower quality assets with the plan to fix them up and then turn around and sell them or go back to the bank and refinance them like I was showing. And they got caught with their pants down. That happens a lot. This is the best time in the market where now we get to take advantage of institutional quality assets, class A properties, best in class, best locations, irreplaceable, below replacement costs, and actually take our money as a group and invest in the best assets in the best city in the nation and be able to control these assets because now is the time these assets have to be sold. Great properties. I'm not talking about the fixer uppers. Like that strategy is good in a different time. This market qualifies for you to be a great investor in quality, institutional quality assets, the big boy stuff. And we can do that if we band together. That's my strategy right now with Bell Capital. My fund is to take advantage or the opportunity of what's going on in the market, which the debt market, there's what, almost $600 billion worth of debt coming due. There's going to be a glut of inventory. Well, there is a glut of inventory that's not trading right now. Um, there's not a lot of property, multifamily assets that are going to be delivered to the market in 2026, which means there's going to be a lack of supply coming in 2027. And that means if we buy a lot of real estate, my goal is to pick up 1,000 units over the next 12 to 18 months. We can take advantage of this new rent spike that's got to happen. It's got to happen, not going to happen in 2027 because all the new properties will be delivered and they're going to drive rents up. And then anyone who already owns assets, good, high quality assets that can compete with new stuff, which is why I said I want newer assets. that rent, that rental market is going to continue to rise up. And the lower stuff, the class C working class stuff, it's going to maintain where it's at. And those people are going to move out of there because, I mean, the rents are going to kind of be the same. They go up every year. So, anyways, that's what I'm looking at. But again, that's the real estate side. But the investment side is this: long-term investment, protect your capital, invest and be patient and wait. Do your cash flow that comes to you, that little drip that you get, you're just being paid to wait for the big bump, which is the double or the triple at the end. Or we do a cash out refinance. You get your money back or a good portion of it, and then you are again still in the deal, and then you get paid to wait for the next bump of another refinance, or we turn around and we sell the package of those, the total assets later 10,000 units or whatever, and we package that up and we go to a Blackstone, a Goldman, a BlackRock, a KKR, and we exit the whole portfolio together. Or I go public, like whichever one. But that's the plan. And I was telling my investors this, or the entrepreneurs that were interested in investing, like the days of the easy money is gone. The real investors have to step up. It's not the operator. It's not the guy that wants to paint and fix stuff. It's the guy that knows how to make good investments and to turn an investment into a winning deal, a winning investment for your investors. That's what I know how to do. All right. So I appreciate you guys. I wanted to share this. I know I went through this quick, but this is how I make sense of a deal. Protect your capital, make sure it cash flows, look for long-term appreciation, steady Eddie stuff, not get rich quick, but get wealthy for sure. And then when you go out, exit and take advantage of the tax advantages and the opportunities to keep more of what you made in your investments. That's what I'm looking at. So let me know if you need anything. Looking forward to helping you guys with anything. If you have any questions, go to bell-capital.com. You can schedule a call or yeah, you can register there your free account to be able to see what we're working on. So number one thing, you got to have a good attitude. You got to already have a good attitude. I don't like dealing with people who are going to cause me problems. I won't do it. The other piece is you got to be liquid, you got to be accredited, and you got to already love real estate. If you don't love real estate, nothing I say is going to make sense to you. If you like Bitcoin, go do Bitcoin. If you like stocks, go do stocks. If you want to invest in AI, you want to do like other little businesses where you just kind of like sporadically do stuff, that's great. Go do those investments. But if you want to invest long term in quality assets that are real, I'm your guy. Trust me, this is what I do all day. So I appreciate you guys. Have a great day today. Let me know if you need anything. Let's get after it. Boom.